Hey, what's going on, everybody? Looks like I'm live on Facebook. So I'm coming at you today, 3:30 in the afternoon on Friday, April 9th. We will call this Financial Fitness Friday. I haven't done my usual Wednesday videos for the last couple of weeks because unfortunately I came down with a very serious case of something called being a slacker. No, not COVID, just being a slacker. So I wanted to come back at you today on Financial Fitness Friday and talk about a few things. Last night we had an awesome class about becoming your own banker. And so I do want to talk about that a little bit more today. But I made a post earlier. I was going through our first quarter numbers about the people that we were able to help out. Using what my friend David Kinder calls wealth contracts. And what he's talking about when he says wealth contracts, he's talking about maximum funded cash value life insurance. And so earlier I posted that in the first quarter of 2021, the people that we helped, we were able to take $4.5 million of retirement income, like pension income, and move it completely off the radar screen of the IRS for income tax purposes. So my clients who enrolled in these plans were able to project with pretty good certainty, not guarantees because some of that's based on dividend performance and interest rates, but we're able to project with pretty close certainty $4.5 million of cash flow, no taxes due, and these distributions don't even have to be filed on an income tax return. So super excited about the great work that we were able to do just in the first quarter of 2021. So much more to come. So that's really as far as like the life insurance piece or the retirement piece, using life insurance cash values as a tax exempt income stream. But when we talk about infinite banking, the great thing about these wealth contracts or these wealth maximization accounts is that you don't have to wait until you're 65 to use your equity or to use your cash value. That's where the infinite banking strategy comes into play because you can use your policies much earlier than that. And this is actually the same type of policy and the same type of strategy that banks use to become wealthy. So today for Financial Fitness Friday, I'm going to talk a little bit more to teach you how to become your own banker and do what the banks, the credit unions, and the other financial institutions do to create wealth. Now, there are basically three things that you can do with money. You can spend it, you can lend with it, or you can own with it. Or I guess you could give it away, but the three main things are spend it, lend it, or own with it. Now, trust me, people know how to spend their money, right? In my friend Brandon's podcast yesterday, he talked about his neighbor, as soon as she got her stimulus check, had a box out in the road for the trash, brand new 75-inch screen TV they got. He saw the box out to the trash. So when people get that money, they want to spend it right away, whether it's from working or whether it's stimulus money or whatever. But that first category, spend it, trust me, people know how to do that, right? Because we all know that most people are not living within their means and most people are not saving. Now, the second one is own with it. And so when people hear own, they think that's the best. I want to own my own home. I want to own these stocks. I want to own my own business. And yeah, that's great. Now, when people hear borrowing or lended, they think that money in a lended position is not as good. In fact, they think it's bad. We've all been conditioned that debt is bad. Now, actually, lending is what makes the world go round. So when people say, Ron, well, what do you do with your money? Well, with the portion of my money, I double dip. I own and I loan with the same money simultaneously. Now, look, let's back up and simplify this. I want you to think about something. If you're to put your money into a bank or a credit union or even a life insurance company, it's in a lended position. Think about it. Are these benevolent institutions that are just paying you interest out of the kindness of their heart? No, they're paying you an interest rate to have possession of your money. You are loaning money to the bank. But what are they doing with the money that you're loaning to them? Because when you loan them money, you're putting it into their savings accounts, their money markets, their CDs, and they get to use that money when it's in there. So they can lend that money back out and use it, and they move it around to make even more money. That's called the velocity of money. It makes the world go round. And they're not using they're not using their own money to make money. They're using your money to make money. It's called OPM, other people's money, and it makes the world go round. It's even biblical. In the parable of the talents, Matthew chapter 25, and in Luke chapter 19, the parable of the pounds, the goal is to multiply money, to be fruitful and multiply. So what we're really trying to do is to create a win-win scenario between someone who's paying interest and someone who's earning interest, but you create what's called the win-win. So when we loan money to the bank and we put it in a CD or we put it into a savings account, they're using that money to make money. So they're taking our money and they're turning around and loaning it back out at, let's say, 4%. Okay. So what are they actually paying us in interest to borrow our money? Because these money markets or these CDs, they might be paying 1% on a good day, in today's current interest rate climate. So they're borrowing at 1% and they're turning around and loaning it back out at 4% or more. So if they're borrowing at 1 and loaning at 4, that's a difference of how much? Now you might have said 3%, but that's wrong. That's the wrong way to think about it. You're not looking at it the right way, because this is what I want you to consider. And I've heard financial advisors, people who don't understand infinite banking say, well, you're going to do all that for 3 or 4%. Well, yeah, banks do it. Banks do it all the time. This is the example I want to give. So if we all collectively deposited $1 million into a bank, take a little money from you, a little money from you, a little money from you, a little money for you, and we deposit it into the bank, it's $1 million. Okay. They're paying us $10,000 of interest, but they're also turning right back around and loaning that money out at 4%. They're making $40,000 of interest. So they'll borrow 10,000 at 10,000 interest to turn around and make 40,000 of interest. They'll borrow 25,000 and have to pay 25,000 of interest in order to turn around and make $100,000 in interest. So how much more is 40,000 than 10,000? How much more is 100,000 versus 25,000? It's 4 times as much. It's 400%. And that's what banks and credit unions do. They're making money on the spread. They're making 400%. Now, back in 2008, when things were getting really bad and most people were losing 40 to 50% in their investments, and many banks were failing and many others were on the verge of failure, do you know that the federal government went to the 5 biggest banks and asked them, where's your money? Where is your money? So while the banks keep their money moving, that velocity of money that we talked about earlier, they're also required to keep reserves. Now, did you know that banks keep a portion of their capital in a position called Tier 1? These Tier 1 assets are for liquidity and they're for safety. So the government went out and they asked the 5 largest banks, where are your Tier 1 assets? Now, do you know where it was? With insurance companies. In certain kinds of insurance contracts, life insurance, maximum funded cash value life insurance. And in the banking industry, it's called BOLI, BOLI, bank owned life insurance, because insurance companies are a $1 trillion industry. They're the backbone of America. They're really the backbone of the world. And you see, banks borrow from us at 1% and loan it out at 4% or more, but they also have to keep a portion in reserves. So they also borrow funds from us at 1%. And for their reserves, they put it with these insurance companies where they're earning 3, 4, 5% tax free. So the question boils down to, when you think about this, it's almost like an investment, right? Would you hire an employee for, let's say, $10,000, and the efforts of this employee would make you an extra $30,000 or $40,000? That's leverage. That's what the banks have been doing. They've been making 300 or 400% on the spread. Now they have overhead costs and whatnot, but that's what banks do. And you can do the same thing. You can become your own bank. Now there's a lot of misinformation and misunderstanding on this. I've heard people quip, well, there's two kinds of people in this world, people who pay interest and people who earn interest. And I say, nope, there's a third person. The financially savvy have learned when it's smart to pay interest in order to make greater interest. People who willingly will pay interest in order to make greater interest. That's what the ultra wealthy do. It's what billionaires do, and it's what the banks do. They learn to borrow at lower rates so they can make higher rates. That's called the spread. Now let's look at how this would work for you with your personal reserves, for your savings. So when I own a home, I'll use a mortgage. And the reason I'll do that is because I can borrow money at, let's say, 3.5%. But that mortgage, that 3.5% is tax deductible. So the net cost is really 2.5%. And if my net cost to own a home is 2.5%, and I'm earning 5% tax-free on my insurance contract, how much more is 5% than 2.5%? It's double. It's 100% more. So I'm owning a house and I'm still earning 100% more on the spread with my capital reserves. So if your mortgage was really only a true cost of 2.5% and you were making nearly 5% tax-free on an insurance contract, again, didn't you just make 100% off the spread? Now, the property itself can go up and down in value, but that does not affect the cash or the return on these wealth contracts, on these insurance policies. So you can separate that equity to earn 100% return on the spread. All the while, with your insurance contract, you maintain control, liquidity, and utilization of your money while still building equity. This is how you can become the bank. So sometimes you pay interest to earn higher interest. So why are we doing things like paying off your mortgage early and killing your cash flow by tying it up in your house where it's just debt equity? This is not what the banks do. They don't tie up their money in debt equity. They keep their money moving. They borrow at lower rates in order to make higher rates. But why let them have all of the fun and make all of the money on the spread? Because you can do the same thing. You can become your own bank and use these secrets of the wealthy in order to get yourself ahead. Look, it's a business decision. It's making the choice to borrow at lower cost or lower interest in order to have your money working for you at higher interest, but just as important, to maintain control and safety and liquidity. Now, let me give you another little secret. Now, this is one about using loan arbitrage to acquire wealth-producing assets. So earlier, I talked about using OPM, other people's money. Well, let's talk about how you can do that, how you can utilize OPM at effectively no cost. Now, sometimes when I talk with people about this, they kind of give me the deer in the headlights look. So I'm only going to go so far with this. But let's say, for example, I have an opportunity, a great deal comes up for me to purchase a cash flowing investment property. Now, whenever I go to use the money that I have in my insurance contract, I can access that money in either two ways. I can either borrow against it or I can withdraw the money. Now, most people would say, well, let's save up money and then withdraw it. But that's the dumb way, because when I withdraw it, I'm no longer earning interest. I just killed my power of compounding and I killed it forever. So here's the smart way. The smart way is, if I want to access money, instead of withdrawing it and killing my power of compounding, I'm going to borrow against the value. Now, here's how it works with the life insurance contract. Let's say that I borrow $100,000 against my policy to purchase this rental real estate. So I borrow it out and the insurance company will charge me, let's say, 5% interest. So by changing the nomenclature from withdraw to borrow, I'm borrowing $100,000. The insurance company is charging me 5% interest. So that's how much? That's easy math, right? They're charging me $5,000 of interest. But because my money isn't withdrawn from my account. Remember that $100,000, it's still in the account. It's earning 5% interest. So on that $100,000, how much is it earning? It's also earning $5,000 in interest. So if I borrow that $100,000, the insurance company is charging me $5,000 in interest, but my $100,000 is still in my policy earning 5% interest or earning $5,000. So it's a wash. And guess what? I still have the investment property. I just acquired a wealth producing asset using OPM, and I've used that incredible power of OPM at effectively no cost. At effectively no cost. So my money is working for me in two places at once, earning interest within the policy and acquiring real estate. See, you are able to loan and own on the same asset if you know what you're doing, if you understand this concept of infinite banking. And another reason that I do this is because I don't want to pay income tax, because when you withdraw, you have to pay income tax on the gain. But when you borrow, guess what? The IRS says you do not have to pay income tax on loan proceeds. Then I can pay myself back at my own leisure. I can recapitalize my insurance contract and then do it again and again and again for future business acquisitions. That's what the wealthy do. That's what financially savvy people do. They do what the banks do. You can become your own bank, and you don't have to be wealthy to do it. You can start capitalizing your own banking policy, your own insurance contract for $250 a month or $25,000 a month. It doesn't matter whether you're wealthy or whether you're middle class. You can use the same concepts that the wealthy do to get ahead. So in my various classes and educational videos, sometimes I talk about what I've heard called the three marvels of wealth. One is compound interest. And a lot of people think they've got a handle on compound interest, but I can tell you that they don't. Why? Because they usually make really stupid mistakes that continually interrupt their power of compounding. So number one is really uninterrupted compound interest. That's the first marvel of wealth. The second marvel of wealth is tax-free compounding. Rothschild said that this is the eighth wonder of the world, tax-free accumulation of compounding. And then the third marvel is one that a lot of people don't understand, and it's exactly what we're talking about with becoming your own banker, and that is safe, positive leverage, the ability to own and control assets with very little or none of your money tied up in that asset. And that's where I've been able to become my own banker, and where I've been able to teach my clients to do the same, pay a nominal interest rate and earn the same amount of interest in my insurance contract using loan arbitrage to acquire wealth producing assets. Like the story in the Bible, we're multiplying our talents. So I hope that you're beginning to understand that you can own and loan on the same asset by becoming your own banker and by increasing your knowledge and your understanding of how money really works. So if this is peaking or even tweaking into some of the ideas that you thought about, but you never really understood, I encourage you to attend my next Infinite Banking Masterclass. Or if you don't want to wait for that, simply message me to set up a one-on-one strategy session. If you liked this video, please share it on your social media page. Get this information out there to other like-minded people so you can introduce them to strategies that they might not even know exists. You can become the bank, and you can use the techniques and the strategies of the wealthy to take back control of your money from the financial matrix. I want you to become a thriver and not just a striver, because now you understand how money works and you understand how it can benefit you the most. Listen, we've come to the end. This is all we've got time for on Financial Fitness Friday. I hope that everybody has an awesome weekend. And as always, I'm here to answer questions and I'm here to help. Take care.